You think you know the S&P 500, but what if I told you this index, one you hear about every single day, contains some of the most shocking, misunderstood, and counterintuitive facts in the entire financial world? Today, you're about to learn why the S&P 500 isn't as diversified as you think, why most investors never actually get the index's real return, and why the S&P 500 has quietly become the most powerful wealth-building machine in history. Let's get into it. The S&P 500 is not 500 equal companies. Most people imagine the S&P 500 like a giant equal list of large U.S. companies. But this index is weighted by market capitalization, meaning the largest companies have far more influence than the smaller ones. The top 10 companies frequently make up more than 30% of the entire index. So even though there are 500 companies inside, a handful of megacorporations determine the majority of the movement. This means you're far more exposed to tech than you realize. Apple, Microsoft, Amazon, and similar giants drive a huge portion of your returns. The step here is simple. Look at your portfolio and check how much of your exposure to the S&P 500 overlaps with your individual tech holdings. Many investors unintentionally double down on the same companies without realizing it. The S&P 500 has removed over 1,000 companies over time. The index may contain 500 companies at any moment, but over the past several decades, more than 1,000 companies have been added and removed. Firms collapse, get acquired, or shrink enough to drop out. Only a tiny percentage remain for long periods. That means the S&P 500 constantly evolves and upgrades itself without you doing anything. Your actionable step is to stop worrying about individual company failures when investing through the index. The S&P 500 does the rebalancing for you automatically. Companies that weaken fall out. Stronger companies rise in. This built-in evolution is one of the main reasons the index performs so consistently over time. The S&P 500 has survived every crisis in modern history. Great Depression, 2 world wars, stagflation in the 70s, the dot-com crash, the 2008 financial crisis, the pandemic crash. Every time, the index eventually recovers and reaches new highs. What makes this shocking is not the crashes themselves, but how quickly the index tends to recover. Historically, the S&P 500 always bounced back, often within a few years. The step here is to stop timing the market. The majority of long-term gains come from staying invested. Investors who panic sell during downturns lock in losses. If you want stability, automate your investments, stay consistent, and stop reacting emotionally to short-term volatility. Most investors never get the S&P 500's real return. The average long-term return of the S&P 500 is around 10% per year, but the average investor earns far less. Why? They buy when it feels safe, they sell when markets fall. They chase performance, they switch strategies, they try to time entry points. The S&P 500 rewards patience, not cleverness. Your step is to set up automatic contributions on the same day each month. This removes emotion, market timing, and hesitation. Dollar cost averaging is the closest thing to a guaranteed long-term strategy most people will ever get. The S&P 500 is one of the most difficult clubs to join. You might assume any large company can become part of the index. Not true. To join, a company must meet requirements related to profitability, liquidity, size, and financial stability. Many large companies fail these requirements. Even Tesla only entered the index after years of debate. This matters because the index is intentionally built to capture strong, profitable U.S. businesses. Your step is straightforward. Understand that owning the S&P 500 means owning a filtered list of elite performers, not the entire market at random. The index is more concentrated than you realize. Many investors think the S&P 500 is fully diversified, but nearly a quarter of the index is technology, and the top sectors dominate most of the movement. Consider this a reminder that owning the S&P 500 still means taking sector bets, just diversified ones. Your step is to evaluate whether you need additional exposure outside the index, such as international stocks, small caps, or emerging markets. If all your investments are tied to the same few large U.S. companies, you're less diversified than you think. The S&P 500 outperforms most professional funds. Over long periods, the majority of actively managed funds underperform the S&P 500. Professional managers with teams of analysts still fail to beat the index. The shocking part is just how consistent this is. Year after year, most active funds lose to the simple, passive S&P 500. Your step is to lean toward index funds unless you have a specific, proven long-term strategy for picking stocks. The index is not just simple, it is competitive. Dividends are a massive part of the S&P's wealth creation. People often focus on price growth, but dividends have historically contributed a significant portion of total returns. Reinvested dividends compound in the background, even during sideways markets. During the 70s and early 2000s, dividends carried the index through long periods of low growth. Your step is to enable automatic dividend reinvestment. This accelerates compounding without any extra work. If you want dividend income later, you can always turn reinvestment off when needed. The S&P 500 is not the U.S. economy. This fact shocks new investors. The index contains only the largest corporations, not small businesses, not private firms, and not the entire economic landscape. Yet these companies often grow even when the broader economy weakens. The index reflects corporate performance, not national well-being. Your actionable step is to avoid assuming the market is a perfect reflection of economic headlines. Markets can rise during recessions and fall during periods of economic growth because they anticipate the future, not the present. 90% of returns come from a small number of stocks. Historically, a tiny percentage of companies create the majority of gains. Most stocks underperform. A small group of winners pulls the index upward. This is why picking individual stocks is so risky for beginners. If you miss those few major winners, your returns suffer dramatically. Your step here is simple. If you're not sure which stocks will become the next major winners, own the entire index and capture them by default. The S&P 500 is quietly becoming more global. Even though the index includes only U.S. companies, most of those businesses earn a significant percentage of their revenue internationally. That means investing in the S&P 500 indirectly gives you global exposure. American multinationals operate in Europe, Asia, South America, and Africa. Your step is to consider whether you want additional international diversification or if your exposure through the S&P 500 is sufficient. Many investors underestimate how global the index already is. Final takeaway: the S&P 500 isn't just a list of 500 companies. It's a constantly evolving machine built to capture the strongest corporations in the U.S. economy. Despite crashes, inflation, wars, and recessions, the index continues to grow because it continuously reinvents itself. It removes losers, keeps winners, and rewards patience above everything. If you want long-term wealth, consistent investing into the S&P 500 remains one of the simplest, most effective strategies available. Not because it's perfect, but because it's resilient, adaptive, and built to survive.